In 2025, the United States Federal Reserve will not cut interest rates. Hearing this from the so-called prophet sounds like a solid fact. But every time this character speaks, something bad seems to be about to happen. Not because he's just a lucky guesser, but because he always appears at the right moment, as if he already holds the script, sometimes even the one writing the upcoming tragedy. Before the 2008 crisis, if you dared say Lehman Brothers had problems, people would laugh at you. Millions trusted Lehman's financial products completely. They saw it as a money-printing machine that allowed them to live carefree without worries. Who would have guessed that trust was the overture to a global disaster? Just 6 days before the financial earthquake, the prophet suddenly appeared again. He downgraded Lehman's credit rating from investment grade to junk status. In other words, he declared Lehman was clinically dead. And exactly 6 days later, Lehman, the empire once considered too big to fail, collapsed into dust. Many people lost everything, even their lives, due to this catastrophic crash. If you think this was just coincidence, fine. But a few years later, the scenario repeated, this time in China. The prophet caused another shock by downgrading a giant real estate company, Evergrande, to junk status. Public opinion exploded. Many accused him of sabotaging. But the truth proved who was really right. Evergrande fell, dragging China's real estate prices down by half. For those who worked their whole lives to buy a home, this crash meant losing half their lifetime savings. Now, the once silent prophet reappears, none other than Moody's. Why does he show up right now? Because the wolf in prophet's clothing is about to start a new attack, this time illegal looting under the guise of credit rating. Sounds unbelievable. Let me clarify. Do you know who the major shareholder behind Moody's is? An old man with a kind smile, fond of Coca-Cola, looking like Santa Claus, Warren Buffett. He seems friendly, but he's not just an investor, he holds the pen, deciding the fate of countless companies. Moody's main job is rating trust. If Moody's gives your company an A rating, it tells the market you're trustworthy, stable, and safe. This helps you borrow money more easily with lower interest rates. But if you're pushed below BBB rating, your company is labeled toxic, unwanted by anyone. Recall 2007, Lehman Brothers held lots of extremely risky assets, mainly bad debt bonds. In reality, the value of those assets had already plummeted long ago. Simply put, Lehman was carrying a pile of garbage in its vault. Yet Moody's coldly gave them an A rating. Do you see what's happening? Recently, I went to a bank to do some paperwork and withdraw some money. The clerk quickly introduced me to some financial products with stable 5% annual returns, labeled as A-rated. He said the only risk was the issuing companies going bankrupt. Sound familiar? This is the 2008 scenario replayed. When you walk into a bank with money, chances are very high you'll be offered investment in Lehman quality products promising stable returns, high safety, and the only risk being the company's bankruptcy. But as long as Moody's gave Lehman an A rating, few were sober enough to doubt it. Thus, the whole world poured money into Lehman's financial products, fully trusting to entrust their assets. But ironically, most of Lehman's portfolio was already worthless. In desperation, Lehman's CEO had no choice but to personally fly to Warren Buffett, hoping the powerful man would rescue them. Buffett agreed but imposed extremely tough conditions. For example, regardless of the future, Lehman had to pay him 9% interest annually. Moreover, no matter how high Lehman's stock price climbed, Buffett retained the right to buy shares at only $40. That seemingly absurd figure turned out to be the price when Lehman was fully liquidated. Meaning even if shares hit $100, he still bought at $40, the lowest possible price. But Lehman's CEO refused these conditions. Just 3 months later, Moody's officially downgraded Lehman to a B rating, destroying whatever market trust was left. Lehman's stock plunged 93% and collapsed completely, triggering the global financial crisis. 10 days later, Goldman Sachs was also on the verge of bankruptcy. Goldman's CEO didn't hesitate to fly to Buffett immediately. Unlike Lehman, he agreed to all Buffett's terms without negotiation. Buffett seized the opportunity to buy at the bottom, not only in Goldman, but also General Electric. In other words, if Lehman wouldn't sell, it didn't matter once it fell. Many others would come knocking. Recently, right after Buffett's statement at the shareholders' meeting, that the dollar is headed for ruin, Moody's, in which he holds a large stake, suddenly downgraded US government bonds. Most notably, the Fed also declared it would no longer cut interest rates. Immediately, both the dollar index and US bonds plunged sharply. What does this mean? It means many big players in the market started to withdraw and sell off both dollars and bonds. Once the white-gloved actors with legal authority to seize assets begin moving, you should understand that Wall Street's elite shooters are ready, loaded, just waiting to pull the trigger. If you don't want to become a sacrificial lamb in this purge, or want to seize the opportunity to break out of your current status, follow my channel. I will share more vital information. If you fear forgetting after watching, press like to save the video. You can reopen and review anytime you're ready to act. First, let's answer a basic question: who decides interest rates in the US? Who has the power to raise or lower them? The answer is the Federal Reserve Fed. What criteria does the Fed use to decide to cut rates? Simply, if average inflation falls below 2%, the Fed will have reason to cut rates, lowering borrowing costs and stimulating the economy. But the problem was, in 2020 inflation was still not below 2%. Yet the Fed unexpectedly cut rates to zero, and printed unlimited money. Why? Fed said unemployment rose so fast during the pandemic that without immediate action, the economy would fall into coma. So they added a new criterion: as long as unemployment rises, they would not only cut rates but also pump money aggressively. However, last year, the Fed reversed course. At the start of the year, they said no more rate cuts because inflation was still high. The economy was growing, and employment was stable. 0822, but by September, inflation was still above target. Yet the Fed again cut rates, citing unemployment still too high, and that cutting sooner would be too late. This month, the Fed loosened the criteria. Again, no need for average inflation below 2%, just 1 month below 2% is enough. Do you notice anything? The criteria keep changing. If one condition isn't met, they add another. If still not met, they lower the bar again. The problem isn't the date, it's that the game's script is already written. The goalposts keep moving. So, the question is, does the Fed really base rate decisions on announced criteria? Does the Fed really have full power to raise or cut US rates? Or do they have a predetermined path and just look for conditions to justify it? You might ask if inflation, employment, or prices really matter to the Fed, or US government. If yes, why impose high import tariffs that raise prices? Why lay off workers, increasing unemployment? Considering these, Trump's claims may not be wrong. The Fed cutting rates now is already too late. You can feel it without numbers. Just visit New York, and you'll see inflation and unemployment severity firsthand. Looking at this chart, the blue line is US bank deposit interest rates, Fed's rates, and the red line is the 2-year US Treasury bond yield. You see both lines move in the same direction when bond yields rise. Bank rates rise when bond yields fall. Bank rates follow. Crucially, the red line bond yield always leads the blue line bank rates. Bond yields rise first, then banks raise rates. Bond yields fall first. Banks cut rates later. This pattern holds over 10 years and even 50 years. Simply put, bond yields move first, and Fed rates follow. Fed interest rates track bond yields, not the other way around. So the truth is, regardless of government or Fed or investors, what matters most is whether US government bonds can be sold. Will the dollar maintain its status as the world's top currency? That's the key. If bank rates are 5% but bond yields only 4%, who would buy bonds? If you had $1 million, would you put it in a bank, earning 5% or lend it to the government for only 4%? When bank rates are higher than bond yields, everyone deposits money in banks. So who buys bonds? Conversely, if bank rates are 4% but bond yields are 5%, what happens? People withdraw money from banks and buy bonds. Some even borrow from banks at 4% to buy bonds yielding 5%. That's a guaranteed 1% risk-free profit. Many use financial leverage to do this, draining banks of cash, not investing or producing, just bleeding the government dry. Banks can then run out of liquidity, possibly causing a financial crisis. Therefore, bank interest rates and bond yields can't diverge too much.